The biggest meeting of 2026 just happened today. Y'all know the Bob, man. It's your boy D-Wall, co-creator of Thinking Gen Wealth. Welcome back to another episode of Wealth Talk. And today we're going to go over the FOMC meeting that just happened today with the new Fed chair, Kevin Warsh. How the hell everything that's conspired just happened, what it means for the stock market, what it means for your debt, and what it means for the next 90 days of you. All right, without further ado, I'm going to share my screen. Let's get straight into it. Wow. So boom, y'all. For y'all that don't know, the FOMC meeting was today. For y'all that don't know what that is, the FOMC meeting is the Federal Open Market Committee, where the Federal Reserve comes together and decides what to do with interest rates and exactly what to look for in the future when it comes to interest rates. Okay. And today was a big one because we have the new Fed chair, Kevin Warsh. This was his first FOMC meeting ever. All right. And today at this meeting, Kevin Warsh and his peoples decided to hold rates steady, but they actually led to potentially having one rate hike this coming year, which is wild crazy because that's the last thing the stock market wants. Okay. So boom, right now the Fed funds rate, y'all that don't know what that is, the Fed funds rate is essentially the interest rate that banks borrow from each other. All right. And the Federal Reserve sets this interest rate. All right. So let's say Bank of America and Chase are borrowing at 3.5%. That means when you go to Chase and ask for a loan, they got to make profit somehow. So they're going to put an extra 2% on top of that 3.5%. So now what are you paying? 5.5%. But that's their little profit margin right there. So the Fed set up the foundation of interest rates, right? And today they decided to hold those interest rates at 3.5 to 3.75%. Now, the big thing that's different is the median dot. So for y'all that don't know, there's a dot plot that the Feds use. And this dot plot is used to dictate where the Feds are expecting them to see interest rates in the future. All right. And in this specific dot plot, they expected interest rates to be at 3.8% by the end of 2026, which is up from 3.4% back in March. So that means they are expecting at least one rate hike. Okay. They're also expecting inflation, aka PCE, the main report that the Feds use to track inflation, to be up 3.6%, which is up from 2.7% 3 months ago. All right, so they're expecting inflation to get hotter, and they're expecting the need to raise hikes at least once. Even just today, 9 out of the 18 Federal Reserve officials wanted a rate hike this year. Only one of them wanted a rate cut. But 9 out of 18, half of them wanted a rate hike this year. So that's a big sign showing that a rate hike, if we don't see any changes in inflation, could possibly be coming, okay? So new Fed chair, Kevin Warsh, like I said, he's the first time being the Fed chair. He took over Jerome Powell. Trump brought him in thinking he's going to lower rates, but Kevin Warsh is big on fixing the data and using what the data tells them to make a decision, all right? And holding on to rates today wasn't a surprise. Like everyone knew that it was going to hold rates today. What they wanted to know is what exactly Kevin Warsh was going to say as far as the future pacing of the market, right? So that's the interesting part. Everyone was expecting, I think, this flat rates overall. But the reality is, with inflation, how it's been looking, and I've been talking about it for mad long, it warrants a hike. So a lot of people, especially the market, did not like that today. That's why we saw a little pullback by the middle to the end of today. All right. So boom. Specifically, the Federal Reserve, what they do is they have a thing called a statement, right? And the statement used to be this long, drawn out thing. Kevin Warsh said, nah, we're cutting this down to 130 words, right? And within this statement, he stated specifically that they're going to hold rates at 3.5 to 3.25%, right? To supporting the Federal Reserve dual mandate. Dual mandate meaning their job is to make sure that maximum employment is given to the American people and that inflation is under control. All right. Now they said specifically economic activity is expanding at a solid pace despite elevated uncertainty that owes in part to the conflict in the Middle East. So they're pretty much saying, hey, the economy is growing. GDP is decent, right? Productivity and growth in capital investment are strong. Again, GDP is decent. Job gains have kept pace with the workforce. They're saying that the job market is smooth and the unemployment rate isn't bad. It's at 4.3%. So they're saying, yo, the economy's tight, Gucci. But they are saying inflation remains elevated relative to the committee's 2% goal. So the Federal Reserve has this 2% goal for inflation. They want inflation at 2%. That's their key, right? Where they got this 2% thing, it don't make no damn sense. The 2% rule actually came from Switzerland back in the 1800s, 19 something, whatever, way back in the day, right? And Switzerland literally just made it up. They was like, damn, what's your inflation be? 2%. Yeah, write that down. And everyone just ran with it. So there's no data behind this 2% thing. It's literally stupid. But a lot of things in this country are stupid. So boom, right? In part of reflecting supply shocks that have driven prices increase in certain sectors, including energy. So they're recognizing that inflation is being led and increased by gas, oil, right? But they made a commitment. The committee will deliver price stability. So essentially, this whole statement is saying, hey, the economy looks Gucci, growth is growing, jobs are being given out, inflation's a problem. We not worried about the other shit. We worried about inflation. That's essentially what they're saying in this statement, right? Now, what was the things that got deleted out of these statements that typically would be in the statement when Jerome or any other Fed chair was involved, right? The easing bias. A lot of people would say we might move to a cut. They would give a little more future pacing on things. That's all gone. Kevin Warsh is not jacking that. He don't want to deal with no future pacing, right? A lot of data dependent and monitor risk. This is a blunt promise. Remember back in the day with Jerome? Jerome be like, yeah, we're data dependent. We're this, that, and the third. Nah, here's saying, oh, listen, we're committed to price stability. We getting inflation down. They telling you what it is. And again, they're not using any forward guidance. Kevin Warsh is not a fan of that. That's why he actually did not include himself in the dot plot, because he doesn't believe in that forward guidance thing, right? So, Kevin, we talking a lot about him. What did he say in his specific words, right? He was pretty much saying, well, three things. He's a lot simpler. He's a lot shorter. All right, he don't waste time. Okay, he's straight to the point, very blunt, right? He declined his own dot. Like I said, in the dot plot, which is pretty much the opinion of all the Federal Reserve chairs, where they think inflation is going to be. He don't believe in future pacing, so he declined that. He didn't even include himself in the dot plot, right? And he also said we can agree to some of the recommendations, disagree with others, and have a good family fight about it. He's doing task force, all right? So within these specific task force, what he's looking for specifically is how the Federal Reserve is gathering data and why is the data so delayed. Because he don't want to deal with data that's delayed so much that it's 6 months behind, this month behind, and make interest rate decisions on that, because that's borderline stupid, which I've been saying for a bit. So I 100% agree with Kevin. There has to be someone looking into that, and we got to use more updated, relevant data. Absolutely, right? Now, the dot plot, I'm talking about all day, right? Here's what the dot plot was today. 1, 2, 3, 4, 5, 6, 7, 8 people was like, hey, let's keep rates the same. 1, 2, 3, 4, 5, 6, 7, 8, 9 people was like, nah, we gotta hike these joints. 3 people wanted hike two rate hikes. You feel what I'm saying? Only one person wanted a rate cut. All right. But what you see, this is for 2026. As we go down to 2027, that's where I'm expecting a little dwindle down. All right. So what this means to us is the feds are focusing on the way to be one and done. Let's do the rate hike now, look what the data tells us, and go from there. So they're going to base off of that one rate hike and see where inflation is at that point, okay? But this was the dot plot for today. 3 people wanted 2 rate hikes this year. That's wild crazy, bro. So boom, that's some good stuff, right? 9 people want hikes this year. 8 people wanted to hold steady. 1 person wanted to cut. Now, how does this compare to March? Because last March is when the last FOMC meeting was. It was Jerome Powell's last FOMC meeting, right? Boom. Now we're here. From March, we're way hotter. All right. We're at 3.8%. In March, we was expecting now to be at 3.4%. You feel what I'm saying? It's getting hotter going down the line. So that's why I think the feds are focusing on, again, price stability, because the main issue that according to the economic data they're seeing is inflation. All right. The interesting part is comparing it to the growth, right? Because they said the economic growth is great, job market's good, unemployment's low, which is true. Like unemployment is low, it's at 4.3%. So it's relatively low. The thing is, though, there's some little hints to stagflation. All right. D-Wall, what's stagflation? Stagflation is when you have higher inflation going up, but you also have declining growth in the economy. So stagflation sucks because it puts the Federal Reserve in a bind. Because if they cut interest rates, yeah, the economy may improve and grow, but so will inflation. Inflation is only going to get worse. So if they say, okay, screw it, we're not going to cut, we're going to raise interest rates. Now, inflation may drop, but your economic growth is going to plummet and people are going to be struggling. So it puts the Feds in a very difficult position. The reason I say there's a little hint of that right here is because of GDP growth, right? We tricked down a little bit from 2.4% in March to 2.2% in June. But we also had an improving employment market, right? And then PCE tricked up heavily, both core PCE, which excludes food and energy, and normal PCEs. Remember, PCE is the main thing the Feds use to track what to do with interest rates based on inflation, right? So this slowdown in GDP growth is concerning around that, because one thing I've been saying is the consumer. The consumer has to be comfortable in this environment to be able to keep up GDP growth. And we had retail sales that came out today, and they were pretty good. So I think the consumer is getting stronger, definitely with the war ending and gas eventually coming down after it delays a bit, about 2 to 4 weeks. I think it's going to get better, but this is something to keep in mind for sure. All right. So what happened in the market? What affected us? Stocks fell. The S&P 500 fell 0.6%. The NASDAQ fell 0.7%. Remember, the S&P 500 tracks the top 500 companies in the country. The NASDAQ tracks the top 100 tech stocks. The Dow, just the Dow. And then the 2-year and the 10-year Treasury, they all ticked up a bit, showing that people are selling off bonds because they're worried about inflation. All right? So that's how the market reacted. Where do we go from here? Like I said, I think we get a hike. I think we get a hike, and it's near here, and markets are pricing in a rate hike for October now. Now, do I think a rate hike is going to kill the whole stock market? No. All right? No. I think a rate hike is going to cause a correction for sure, maybe 8 to 10% on the indexes, on the SPY, QQQ, whatever, right? But do I think we get into a bear market because of that? No, because one thing we got to keep in mind is, what do one rate hike actually change? All right. The biggest thing behind the stock market and the thesis is AI. And the biggest thing that's driving this AI build out is CapEx, aka businesses spending mad money to invest in the AI. All right. Now, rate hikes is not going to stop Amazon from spending mad bread in AI. Rate hikes is not going to stop Google from spending mad bread in AI. All right. Because what? These companies are not using debt to invest. They're using their own cash flow to invest into the business, their free cash flow. Okay. So that's why I don't think one rate hike cracks the whole market and it's over. Oh, woo, woo, woo. No. Now, I do think we get a pullback, specifically in the stocks that's already beat up, such as the Microsofts and the Amazons and et cetera, because people are starting to run away from the balance sheets and the strong businesses and start to chase after the volatility in the stock market. All right. So personally, I think the winners, if there is ever to be a rate hike, is going to be those who buy the dip on strong businesses with strong moats and are going to be around for the next 10 plus years. The Microsofts, the Amazons, the Googles, the Nvidias, the what else? The Apples. All those types of businesses are not going anywhere, and interest rates are not going to affect them. Right? Now, if we get more than one rate hike, let's say we get 2, I still think the thesis is there, but the vulnerable part we got to focus on is the valuation of these businesses now, right? Because I think the market believes that CapEx is still going to go. But the thing is, once interest rates rise, business expenses rise, and that leads to a re-rating in certain stocks. Because now that a business is paying more money towards debt, now you may have less earnings per share. And that's going to cause you to your stock to be essentially re-rated based on how much value you can provide shareholders. If you're paying more expenses, you can't provide as much value to the shareholder as you were before. So now that's where we can see a little crack in the market for sure. But do I think it kills the thesis? No, because again, these businesses are not going to stop spending money on this AI build out. We're in year zero of this 10, 15-year build out. Okay. It's not going anywhere, especially with the hyperscalers like Google and Amazon and all of them, right? It's not going anywhere. So, y'all, I say all that to say, let's calm the hell down and let's buy strong companies that have great balance sheets, that we know has great leadership, and relax. Just fucking relax, bro. We'll be all right. Just buy the strong companies, the Microsofts, the Amazons, the Apples, the Googles. I love my fintechs. I love Robinhood. I love SoFi. I love NU. What else I love? There's so many stocks I love because they're strong businesses, not because we're chasing volatility. If you want to chase volatility, prepare for something to happen to you if this happens. Okay? I do think this will lead to an opportunity if this were to happen. But again, we have to have a level head behind it. All right. So boom. That's how it's going to affect the stock market if that were to go. This is how it could affect your debt now, right? When it comes to interest rates, like I said, the Fed fund rates increase. If they were to increase, that will cause your changing debt, your non-firm debt, your non-fixed debt, your I forget what the exact word is, but your variable debt, your variable APR debt, meaning your credit cards, meaning if you have a APR, a variable debt with your mortgage or anything like that, that could increase if we get a rate hike, which could cause more expenses under you. So the number one thing I would focus on, just to be safe, is to pay down any high interest debt, credit card debt, any loan debt that's above 9%. Pay those down as much as possible so that way you don't get screwed when it comes to rate hikes for any variable debt, predominantly credit card. There's not a lot of loans out there that has variable debt. Most of it is fixed, but credit cards, you got to pay that down to play it safe. Okay. What that means for the next 90 days for you, nothing really changes, honestly. Pay down your debt, invest into the strong companies. Right now, my favorites that I'm investing to personally, this is not financial advice. Do your own research. I love Microsoft here. I still love Google here, even though it's not as down as it was before. I still love Google here. I love Meta. Meta is a great business. Those are really my top three right there. Microsoft, Google, and Meta. All right. MasterCard, I gotta throw in there. MasterCard is a great stock, very cheap at the price right now. There's a ISRG. Started looking into ISRG. I think they're a great business. I want to start dollar cost averaging into them as well. But again, do your own research on everything behind that. All right, y'all. That's what happened today. Y'all let me know if you got any questions in the comments. And y'all want to chat more about all this stock stuff, feel free to tap into our Discord. It's D-War. I'm out of here.